336 bank branches have shut down in 2025. Not next year. Not over the next decade. Already closed. As of May 2nd, 336 branches across America have locked their doors. And more closures are coming. Think about that for a second. Santander just closed 18 branches across the Northeast. U.S. Bank is shutting down 40 locations. Wells Fargo, 49 closures. Flagstar, 52. TD Bank, 37. JP Morgan Chase has closed 375 branches since January 2024 alone. Bank of America shut down 132 locations last year. The official explanation? Digital banking. Customers prefer apps. Fewer people visit branches. It's all about efficiency and customer convenience. But that's not the real reason. Because if you map where these branches are closing, a pattern emerges. They're not closing in wealthy suburbs. They're fleeing specific regions. Low-income neighborhoods, minority communities, and areas with one thing in common: toxic commercial real estate exposure. Banks aren't adapting to digital trends. They're running from a ticking time bomb, and the communities they're abandoning? They're about to become financial wastelands. But before we reveal which regions are being targeted for extinction, you need to understand the mechanism behind this mass retreat. Because this isn't about convenience. This is about survival. Let's start with the number that Wall Street doesn't want you to see: 1,522. That's how many banks in America have commercial real estate exposures greater than 300% of their equity capital. 732 banks have exposures greater than 400%. 320 banks are above 500%. And 113 banks have commercial real estate exposure exceeding 600%. Translation: if commercial real estate values drop by 20 to 30%, over 1,000 banks are technically insolvent. Rebel Cole, Lynn eminent scholar, chaired professor of finance at Florida Atlantic University, analyzed Q4 2023 bank regulatory data and warned that sinking demand for office space in the commercial real estate market could lead to bank failures in parts of the country. He said, the demand for office space has fundamentally shifted downward. During the pandemic, people began to work from home instead of heading into the office. Now, 4 years later, that is still the case. It's a problem for the banking system as there are a lot of banks that have extensive exposure to risk. Here's the death spiral. Banks lend money to commercial real estate developers to build office towers, retail centers, apartment complexes. Those loans are backed by the value of the property, but if people work from home, office buildings sit empty. Vacancy rates spike, rental income collapses. Property values plummet, the loan becomes underwater. The borrower defaults. The bank takes a loss. But it gets worse. When one owner walks away from a building, it creates a comparable sale at a huge discount, leading appraisers to mark down the value of other properties with positive cash flows that triggers a cascade. More defaults, more foreclosures, more losses. And the banks most exposed? Regional and community banks. The ones operating physical branches in the very neighborhoods where commercial real estate is collapsing. So they're closing branches in those regions before the bomb goes off. Now let's talk about where these closures are happening, because the geographic pattern reveals everything. California, Texas, and New York top the list of states with the most closures in 2025. The Midwest recorded the highest regional closure rate, with 19% of branches shuttered since January. The South followed with 850 closures, heavily impacting small-town and suburban banking services. Appalachian regions face emerging banking deserts, where residents must travel 20-plus miles for in-person banking. But here's the chart that changes everything. Urban minority neighborhoods and low-income communities account for a disproportionate share of closures. The National Community Reinvestment Coalition found that banks took advantage of the COVID-19 pandemic to double the pace of branch closures in these areas. While the intensity of the pace of branch closures increased nationally, several large metropolitan areas saw banks retreat from branch service at an even faster clip. Banks closed twice as many branches in Los Angeles during the pandemic as they had closed in the prior 20 months. Closures tripled in Washington, D.C. Boston had a 1,375% increase. San Francisco saw a 617% increase. These aren't random closures, these are strategic retreats. A 2022 report from the National Community Reinvestment Coalition stated, in the midst of economic uncertainty, high unemployment, and a mounting death toll, Banks decided to take advantage of the crisis and economic downturn to rapidly increase the pace of bank closures. 9% of all branch locations in the U.S. closed between 2017 and 2021, a loss of about 7,500 brick-and-mortar locations. Community banks, those with less than $10 billion in assets, accounted for 29% of closures, primarily in low-income districts. And these aren't just inconveniences. Branch closures in low and moderate-income neighborhoods, which are disproportionately communities of color, reduce access to credit, including mortgages and small business loans, as well as savings accounts and other basic financial services. The Federal Reserve's 2025 Banking Access Report highlights a growing banking desert issue in Midwestern states. As of Q2 2025, the total number of active U.S. bank branches has dropped below. And the people living in these deserts? 3.74 million Americans. Of those, 291,560 were in urban lower-income tracts. 475,156 were in rural lower-income tracts. 265,323 were in urban majority-minority tracts, and 209,011 were in rural majority-minority tracts. Translation: banks are abandoning the poorest and most vulnerable Americans right when they need access to financial services the most. So why are Santander and U.S. banks specifically fleeing the Northeast? Because that's where commercial real estate exposure is most toxic. Santander Bank closed 18 branches across New York, New Jersey, and Pennsylvania between July 31st and August 21st, 2025. That's 4.5% of its U.S. branch network gone in less than a month. The official statement? Santander Bank is continually refining its branch network and retail presence to better serve our customers. But here is what they didn't say. The Northeast has some of the highest office vacancy rates in the country. New York City office vacancy hit 22% in 2024. Manhattan commercial real estate values have dropped by over 30% since 2022, and banks with heavy exposure to Northeast commercial real estate are staring at billions in potential losses. U.S. Bank is closing 40 locations nationwide. Wells Fargo, 49. TD Bank, 37. These aren't efficiency moves. These are defensive maneuvers. Experts agree that it is possible some banks will fail, particularly in areas like the Northeast and California, where many offices remain vacant due to remote work. The Sunbelt states, Colorado, Florida, and Utah, are less prone to bank failures due to the demand for office space as workers and businesses migrate into these areas. So banks are closing branches in the Northeast and California and shifting resources to the Sunbelt. They're not adapting to digital banking. They're fleeing regions where their loan portfolios are about to implode. JP Morgan Chase closed 375 branches since January 2024. But now the bank says it is running out of branches to close. Why? Because they've already abandoned the most vulnerable markets. They've consolidated overlapping branches in major metros. And now they're left with the core network they need to maintain market presence. But smaller banks? They don't have that luxury. Branches in potential banking deserts are small, with median deposits of just $23 million in urban areas and $20 million in rural areas. They tend to be operated by small banks, with median total assets of $776 million in urban areas and $317 million in rural areas. Translation: the small size of these branches and the banks that own them suggest that what stands between a community and its isolation within a new banking desert are not the decisions made by big banks with a national footprint, but, rather, the decisions made by locally oriented community banks. And those community banks are the ones with the highest commercial real estate exposure. Over 1,500 of them are sitting on CRE loan portfolios worth more than 300% of their equity capital. If commercial real estate crashes, they fail. And when they fail, their branches close, and those communities become banking deserts. So here is the extinction event scenario. Commercial real estate values drop another 20 to 30% over the next 12 to 18 months. Office vacancy rates stay elevated. Loan defaults accelerate. Regional banks with high CRE exposure start failing. The FDIC steps in. Branches close. Banking deserts expand. By 2030, the number of bank branches in the U.S. could drop below 16,000, a historic low not witnessed since 1965. That's a 75% decline from the 2010 peak of over 90,000 branches. And the people hurt most? Low-income families, minority communities, rural Americans. The 3.74 million people already living in banking deserts will grow to over 10 million. Access to credit vanishes. Small businesses can't get loans. Wealth building becomes impossible. A University of Minnesota Law Review article titled Banking Deserts, Structural Racism and Merger Law stated, banking deserts are generally in low and moderate income neighborhoods, which are disproportionately communities of color. Residents of banking deserts lack access to credit, including mortgages and small business loans, as well as savings accounts and other basic financial services. These policies created black neighborhoods without banks, locking minority families into cycles of poverty. 336 branches closed in the first 5 months of 2025, over 900 to 1,400 closures projected by year-end. Santander, U.S. Bank, Wells Fargo, TD Bank, all fleeing the Northeast and California. Banking deserts expanding across the Midwest and Appalachia. 1,522 banks sitting on toxic commercial real estate exposure. This isn't digital transformation. This is a controlled retreat before the collapse. Are you watching the show? Or are you living in the next banking desert? What do you think? Drop your answer in the comments below.